Okay, and we're live. So, good afternoon, and thank you for joining us today. My name is Kobe Kushner. I'm a mining analyst here at Red Cloud Securities. I'm delighted to host another Red Cloud webinar. This time it's on uranium. We will hear from Consolidated Uranium President and CEO, Phil Williams. And during today's webinar, he will provide us with an overview and an outlook. Then we'll take some questions, and you can type your questions into the chat box at any time. We can get to as many as we can. And before we kick things off, we do have to run through the fine print. So during this Consolidated Uranium webinar, forward-looking statements may be made. I would direct listeners to the forward-looking statements outlined on page 2 of the company deck. That can be found on the company's website, consolidateduranium.com. And for Red Cloud Securities Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities, and we note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures on Consolidated. Before Phil steps up, I would like to say a couple words on the uranium market. So uranium has been in and out of the spotlight as of recent. It started the year at $40 a pound, was hovering between 60, 65 in mid-April. Those were the highest prices since March 2011, perhaps on the back of ongoing news from Ukraine and fear of Russian uranium and enrichment disruptions. Since then, spot buying has slowed. Fears of the Russian-Ukrainian impact may have somewhat dissipated, and uranium prices have dropped. They're now sitting around $46 as of yesterday. It's clear that the spot market is quite volatile, and history tells us that prices could rebound just as quickly as they've dropped. With prices down, uranium stocks have been hit. Many uranium companies are off between 20-50% over the past month. Consolidated is running about mid-pack within its developer peers. But we believe Consolidated is transforming itself into a near-term producer, and we expect a re-rating when that comes around. And we still like the potential for uranium fundamentals to drive uranium prices higher. With disinvestment in the uranium sector, there has been a lack of exploration and discoveries, and new mines will be needed in the coming few years to replace mine closures to let alone cover the growth in uranium demand. And with that, I'll now turn it over to you, Phil, to update our audience on the company.
Thank you, Cody, and thank you everyone for joining today. Very happy to be back presenting to the Red Cloud client base. Consolidated Uranium, for those of you that don't know, we're a global uranium developer with a particular focus on near-term production on our U.S. assets. And I'm happy to report today, and we put this news out earlier today, that we've started the first drill program on these projects. And the first drill is in the ground and was complete as of this morning. And I'll take you through a bit more detail around what we're doing there. This picture on the front is the Tony M project, and this is actually where the first drill program is underway right now. The disclaimers that Cody mentioned are here. So just stepping back to the story of the company, when we put this company together just over 2 years ago, this was kind of the idea. We were going after what we believe was the right strategy, uranium emerging from a 10-year bear market. We also came up with this strategy of consolidation to go and acquire assets around the world in different jurisdictions at different stages of development. And that was really based on a very successful strategy that was deployed by a number of companies in the last bull market. And I'll show you the success, the case study of success for that. And now we're still focused on growing the portfolio through M&A, but we're also pivoting to advancing our projects that we have. As I highlighted at the beginning, we are drilling in the U.S. right now, and we have a work program underway in Argentina. The company was founded by what we would consider the right team, the leaders behind Next Gen Energy and Mega Uranium, names that many of you would be familiar with, and they're still involved today. But over the last 2 years, we've added significantly to the management and the board experience, both in the uranium space, of course, also mining and finance and project development. And now, 2 years on, after acquiring 13 projects in 4 jurisdictions around the world, we feel like we have a very strong asset base. This diversification approach is very key for us, and I think we're seeing it play out particularly geopolitically, that being in the jurisdictions that we are in and diversified across them will serve us very well. And we'll hammer this point home again and again through the presentation, but we really are very much focused in the U.S. for a number of different reasons, but particularly because our projects are extremely advanced there and could be ready for production as soon as next year. And we're fully funded. We raised money at the end of last year, and we have about $27 million in cash to execute on this business plan. Here's a snapshot of the company's share cap table and some of the investors in the business. As Cody highlighted at the beginning, the uranium equities have corrected quite dramatically in some cases. We're starting to recover a little bit in the last few days, but certainly it has been a tough couple of weeks for the sector. As I mentioned, we are well capitalized. It says 30 million there. We just put our financials out yesterday. It's about 27 million now in working capital. And in terms of our shareholder base, you can see that Energy Fuels is the biggest shareholder. Energy Fuels got that position from the acquisition of the projects in the U.S., which we acquired from them last year. We do have a number of other institutional investors behind this list that you can see there. All of the capital that we've raised over the last few years, which is about $50 million, was largely subscribed to by institutional investors around the world and very resource-focused investors, as well as uranium-focused funds, who many of you would be familiar with. And Dave Talbot, of course, covers the stock. We talked about building the team out. So for those of you that don't know me, I'm 20 years in the capital markets with a significant amount of time spent in uranium. In 2006, I was a research analyst covering the uranium space. I then went on to work at an investment fund where we managed about $1 billion focused on junior resource investment. A significant amount of that was invested in uranium, and that was my mandate. I then went into investment banking, was a banker that covered many different commodities with a particular focus on uranium. Over that period of time, I financed many of the companies that are existing in the space today and was an advisor on a number of M&A transactions. In 2017, I stepped out and with some partners founded a private uranium royalty company called Uranium Royalty Corporation. It's now public. I was the CEO there for the first 2 years. And then 2 years ago, I came and started this company with the partners here. I would say one thing that would stand out about my experience, and behind me I have a map of the world, of all the uranium projects in the world. I've probably stepped foot on 100 different uranium projects around the world. So I think, and what we do when we go to acquire projects, we do take a boots on the ground approach. And having been to a number of the projects that we've acquired, puts us in very good standing. In terms of the team, the rest of the team, all I will highlight today is as we're making this pivot from M&A and building the portfolio out to actually advancing the projects, we certainly recognize that we wanted to add more technical expertise to our team. Late last year, Marty Tunney joined. He's the president and COO. He's an 18-year mining engineer, has built and permitted many mines across the Americas. And so he's leading the charge on the technical side of our projects. And then also Mark Chalmers joined the board. And that was part of the transaction that we entered into with Energy Fuels. Mark's a 40-year mining engineer. He's worked in uranium mines around the world and brings tremendous experience to the team. I talked about this consolidation strategy. When we first started the business 2 years ago, we put the chart on the top together. And this is a 2-year chart for Mega Uranium in 2005 and 2006. And for those that aren't familiar, this is the first sort of real bull market in the uranium space that happened. And ultimately, uranium prices went from in the 20s at the beginning of 2005 to 137 in early 2007. In those 2-year periods, you can see that Mega was a consolidator. They acquired 9 projects, or they did 9 acquisitions of projects around the world. They raised capital, and they had a tremendous share price and market cap increase. You can see 3,400%. And a 15 million to 940 million market cap increase. That was the business plan at the beginning. We said, let's go redo that. And then, so now what we've been able to do is put together this similar chart for the last 2 years of what we've been able to complete. And it looks very similar in the sense of the number of acquisitions that we've done, the capital we've raised. We have had tremendous share price appreciation, notwithstanding the recent pullback, and the market cap has grown tremendously over that period of time as well. I think what I would highlight to investors here, as you're looking at what the opportunity in the sector is, particularly now that names have corrected quite dramatically, is that if we're of the view that uranium prices are going to continue to move and potentially move up to those levels that they moved in 2007, there's a lot of runway on the valuation side relative to the performance of the equities in that previous bull market. And so I think that's a very positive signal for where equities can go. And not just Consolidated, of course, other uranium equities as well. So now we'll take a look at the portfolio. And as I mentioned, we've acquired a diversified portfolio. So now we're in 4 jurisdictions. We're in Australia, we're in Canada, we're in the US, and we're in Argentina. And when we took a look at where we wanted to be, we certainly looked at criteria like, is the country a good mining jurisdiction? Do they have uranium mines? Are they nuclear countries? Are they stable countries? And when countries checked 2 or 3 of those boxes, they got high on our list of countries that we wanted to have projects in. And so I think, these countries particularly are more stable and better jurisdictions for developing uranium projects. Uranium is a very hard commodity to develop. And so being in these better jurisdictions, certainly I think will serve us very well. All of the projects that we've acquired to date have historic resources. And so when we started the business 2 years ago, it was on the premise that a number of projects were forgotten about, orphaned from the previous cycle where significant capital was spent, resources were in place, but nobody was doing anything on the projects, whether they were sitting in the backs of portfolios, had been abandoned for some reason. And so that was the criteria that we went to acquire these projects. So now we have a critical mass of resources, both uranium and vanadium. Vanadium is something that often is found with uranium, and several of our projects around the world do have vanadium. And it's having a reasonable moment as well. The commodity price of vanadium has kind of doubled in the last year or so. One thing I would highlight on this map is the blue Moran Lake project. One of the things that we're always doing and always thinking about in terms of building out the portfolio is how we're going to ultimately realize value from the projects. And in the case of Moran Lake, earlier this year, we spun the Moran Lake project out into a new company called Labrador Uranium, with some other projects from Altius and Mega Uranium, created a new company, financed it separately, and distributed the shares of the company that we received for putting Moran Lake into that vehicle directly to shareholders. So all shareholders got direct exposure to that company. It's now well funded and going off on a very aggressive exploration program this summer. The focus of the company, as I pointed out earlier, is on the U.S. projects. Those are the projects in the dark green labels with the white lettering. They're in Utah and Colorado, and these are the projects that we acquired from Energy Fuels, and we'll go right into those. Here's a zoom in on the area, and the main projects that we're going to focus on here today and with the company are the Rim Mine, the Dineros Mine, the Tony M Mine. These are historic mines. They were in production in that past bull market. They were in production from 2008 to 2013, and a tremendous amount of capital was spent on these projects. These mines are fully built, and you can see a little bit in the images here. There's head frames, there's portals, there's lots of surface infrastructure. Over $100 million was spent on these projects. And what that means for us is we don't have to spend a lot of additional capital to bring these back into production. They are built mines. And I think that's one thing that will set us apart from some of the developer peers in the US particularly. There are historic resources in place on all of these projects, and I'll show you that when we talk about each project individually. We do see tremendous exploration potential, and that's what the drill programs are primarily targeting, and I'll talk to you about that in a second. The other thing that's very important for these projects that, again, I think differentiates us from our peers is that these projects are fully permitted to go into production. When they went offline, Energy Fuels was very specific about keeping all of the relevant permits in place so that we could turn them back on very, very quickly. And what that means for us is it's a very much a large time saving for moving these projects back into production. So you can see we've estimated that if you wanted to permit these mines from scratch, it's a 3 to 5 year exercise and about $1 million per mine. We don't have to do that. We can go ahead almost immediately and put these projects back into production. Our strategy today at this point in time is to execute these drill programs based on results and based on where the market is in the second half of the year, be ready to make a production decision. And the third aspect of these projects that's very important is they're all in trucking distance to Energy Fuels' White Mesa Mill. For those that don't know, the White Mesa Mill is the only operable, licensed, permitted mill in the US today. We, as part of our transaction with Energy Fuels, we secured a toll milling agreement. We're the only company with a toll milling agreement. So a conventional miner in the US that mines their ore, they need to process it at a mill, and the White Mesa Mill is the only game in town, and we have the only toll milling agreement. Again, I think that puts us in a very enviable position amongst our peer group. And so just to delve into the strategic alliance with Energy Fuels, and that's what we refer to it as, and that's how we view it. It was not simply a sale of assets. We really have become partners with Energy Fuels. They're a big shareholder, obviously, as we pointed out, and their investments, their shareholding is governed by an investor rights agreement, which gives them equity participation. The board seat that you saw, Mark Chalmers is on the board. The toll milling agreement, which I mentioned, was also part of that. And then we have this operating agreement, which is a fairly unique agreement for a junior, whereby we get full access to the Energy Fuels team to help advance these projects. And really what that looks like is here on this page. And so, of course, you need a lot of people to advance projects. You need capable people in different disciplines. We're starting to build our owners team, and Marty's put together this group of people on the left-hand side of the page who are geologists, who are project managers, who are permitting people that work directly for our company. But under the operating agreement, we have the ability to access Energy Fuels' team, and some of the names there. These are people that are experts in their discipline, but more importantly, they have direct experience operating the projects that we're talking about. They were there working these projects when they were in production in the past. We second them to the projects as we need them. Of course, we pay for that under the operating agreement, but it meant that we don't have to build out that entire team ourselves. And of course, we get the benefit of their tremendous experience with the projects. Again, I think it's a very significant benefit and differentiating factor for us versus our peers, who probably wouldn't have such a deep technical team to access for their projects. Let's go straight into the projects now. The first project I'll talk about is Tony M. That's the picture on the front of the slide presentation. This is the project we're drilling right now. This is the largest project in terms of resources. You can see that there's circa 11 million pounds of uranium at good grades. What's very exciting about this project and why we're why we're focused on it is there's a tremendous amount of development. So you can see that there were 18 miles of underground development in the map here, in the plan map. That's represented by the sort of brown lines that go down and across the ore body there. And there's tremendous surface infrastructure. When Denison, the predecessor owner of this project, was mining it, they put in $15 million of surface infrastructure, including some of the ore bays that you can see there. And then in the foreground and in the background to this image, there's buildings, shops, offices, etc. And we have all the benefit of that. Again, it just means we don't have to build any of that. It's there in place and in very good condition. The other thing that's important about this project is it's been very significantly drilled. You can see there's 6,500 drill holes, over 1.5 million feet of drilling. We're very confident in the resource. Our drill program today that's underway is an 8-hole program. It's being drilled within that blue circle there. And this is confirmation drilling of the historic resources and the historic holes, such that we can go and put together a updated 43-101 report on this project toward the end of the year. The Dineros is the second mine. This mine was originally acquired by Denison in 2011 for Aussie $57 million, which on its own is more than the entire purchase price that we paid for the package. So again, we think we got a very good deal here. Like Tony M, it was in production in the past. Tony M, and I didn't highlight it in that moment, but over 1 million pounds has been produced there. About 1 million pounds has been produced from Dineros. And of course, there's surface and underground development and infrastructure in place here, just like Tony M. Not as extensive, it's not as big a project, so it doesn't need quite as much infrastructure, but it's all there again and ready to go back. What we're excited about here, and you'll notice that the resource is not nearly as large as Tony M, And that was really a function of, or the historic resource, to correct myself, it's really a function of when they were mining it. They weren't drilling off resources in front of them. They were simply mining, and they knew just a little bit, they just needed a little bit of ore that they could see in front of them. What we've uncovered, and with the help of the Energy Fuels team, is we've gone back in and looked at all the data, and it's a bit hard to maybe see in this slide. And if you go to our website, you can zoom in on it a little bit more. But in the orange here in this plan map is the historic resources you can see there. And again, it's not a huge resource, but it's very high grade by global standards. And but there's tremendous exploration potential. And where we've shown the pink, these are areas where there are historic drill results that are ore grade and ore widths that aren't included in the resource area. And so our geologists have come up with an 8-hole drill program, again in this blue circle here, to follow up on some of those historic holes. We're not twinning these holes. We're going to step out from those holes again with the view to expanding those historic resources. And based on success, we would look to do maybe some more surface drilling after this, or potentially go underground and drill it. The Rim Mine, this is the third project. Similar to Dineros, again, it was in production. You can see the head frame, and there's tremendous underground development here as well. It's a smaller resource. What's exciting about Rim particularly is the very, very high grade vanadium content. So this ratio of 9:1 would make it one of the highest ratio vanadium to uranium mines in this part of the world. And at 1.8% vanadium, it may even be one of the highest grade vanadium projects in the world on that basis, not to mention that at 0.2% uranium is very good grade. Just like Dineros, we've got a map here that shows the orange historic resources and the pink area where we have historic drill holes that point to mineralization at ore widths and ore grades. And our team has put together a 15-hole program drilling within this blue circle to chase extensions to the known mineralization. Again, if we have success here, we'll look to expand that program and continue to build out resources. Talk about the permitting situation. This is quite a busy slide, but I think it makes the point. Here are all the permits you need. We have check marks for all of them where they're needed. The important and hard to get permits, let's call them, are the plan of operations from the BLM and the mine permit from the Utah, the state government. Again, those are in place. Those are 3 to 5 year exercises if you didn't have them in place. And I would encourage you to ask some of our peers if they have tables like this that they could show you, just to see what stage of permitting there are, and give you a sense of how quickly a mine could come back on. On this basis, we could be turning the mine on in a matter of months, not years, which might be the case for some of our peers. We're in the U.S. We particularly like this jurisdiction. For those of you that don't know, it's the #1 producer of nuclear power, so therefore the #1 consumer of uranium. At the same time, it has a very small current domestic production, and it's been recognized over the last several years that that's a situation that has to change. And I think it's particularly more important today with everything that's happening geopolitically. And there's a number of initiatives that the U.S. government has been working on to try to encourage domestic supply, and we would be the beneficiaries of some of these programs as they move forward. And I think it's well recognized by the investment community that U.S. projects trade at a premium, or should trade at a premium. And you can see that in the following table, which is very kind of generic valuation comparable between ourselves and some of our other U.S. peers, and it's enterprise value to pounds of uranium. And you can see, particularly on the left-hand side of this graphic, the standout, the near-term producer companies that you might be familiar with, the sort of strong companies in the industry, the UR Energies, the Energy Fuels, and the UECs. They traded at a significant premium to the developers because of that the U.S. near-term production capability. All of these companies have permitted, licensed mines and facilities to mine and produce uranium. We also are in that position, yet we don't trade at that level yet. I think what we need to do as a company is show the market, show investors that we belong in that category. I hopefully think I've demonstrated by talking you through the characteristics of our projects that we do. And as we work on the projects and show some of the results from our drilling and work on making that production decision towards the second half of the year, I think that we have an opportunity to re-rate at least to these development peers, and if not, hopefully ultimately to the near-term production peers on the left-hand side of the chart. We have this full pipeline of other projects. We categorize them in near-term production, potential development, and exploration. Of course, the U.S. projects are there in near-term production. On the potential development side, we are doing work at the Laguna Salada project in Argentina. We found some very interesting potential extensions to the mineralization there, and we're pretty excited about that. We do have a number of other projects that you can see in the portfolio, and we will do some work over in Australia towards the second half of the year. And what we're doing is we're looking at all of these projects and seeing where they might fit ultimately in the portfolio as we build a production and development business. Some of these projects may or may not fit within that model, and as such, we might look to spin them out, just like we did with Labrador Uranium very successfully. So, catalysts for 2022. We have the work programs that I mentioned going on in the U.S. and in Argentina. And what's particularly interesting about uranium exploration is you know very quickly whether you're having success, because you can use probes to get the radiometric data immediately, so you know when you're in the ore zone. And so I think we can have some results out very, very quickly on that front. As I mentioned, we will start some Australian work programs towards the end of the year. We do have a project that we don't spend a lot of time talking about in Quebec, which is a very high-grade, potentially world-class ore body that we bought. We bought the project. It's called Matouche. We bought it out of bankruptcy last year, and it has the potential value of this project is equal to the value of the company as it is, but we need to make some progress with the local stakeholders, and so we're working on a plan there. If we can make progress there, I think we can unlock tremendous value for the company there, and we're continuing to evaluate other opportunities, particularly opportunities that are complementary to the project portfolio we have, and then looking at other ways to, as I said in the last slide, unlock value in some of the other projects in the portfolio. So that's the story. It's an attractive portfolio of uranium projects. We're in top-tier jurisdictions. We have high grades on a global scale, tremendous past expenditures on these projects, and near-term production potential in the U.S. We're busy evaluating new opportunities, and I think based on the history of the company, we've been very busy historically. We'll continue to be busy on this front going forward. We believe, of course, we have a compelling valuation and are well funded to execute on our business plan, and a proven track record of the team, both within what we've already done in this company and what we've done externally to the company before we came here. So that is the story, Cody, and very happy to take questions.
All right, thank you, Phil, for a very informative presentation. And as you said, we'll now start with the Q&A portion of the webinar. Just a reminder to everyone on the line that you can type your questions into the chat box at any point. We do have a few questions here, and I think Phil's already done a good job at addressing most of them already in his presentation, but it never hurts to reiterate some of the key points. So something we didn't really touch on, Phil, and I mentioned it a bit at the beginning here, talking about the ongoing war with Ukraine and Russia and spot buying. And you follow this market a lot more than I do. So am I missing something else here? What's your take on the recent price movements?
Yeah, look, I think and I think what everyone maybe knows or should know is that there's two parts to this market. There's a spot price that everybody sees every day, and that's the price that really drives the psychology around where uranium equities are trading. And then there's the long-term price, and that's the price that utilities transact on. And that's the price that really matters to producers. On the spot side, I think it's largely been driven by macro market momentum and financial players. So it was clearly Sprott Physical Trust that played a big role in moving the price up to where it got to at $63.50 or whatever it was. And then when they kind of lost their ability to keep buying material, when it began to trade at a discount and they couldn't raise money under the ATM, other financial players, traders the spot market is characterized by traders. They exerted pressure the other way, and then overlay just a weaker macro environment and a chase for people looking for more liquidity. I think that helped sort of push the price down to where it is. On the term side, we have seen it move up. I think what we're finding in the background and anecdotally is that utilities are aware that that higher prices are required to move projects ahead. If they want more diversification of supply, security of supply in other jurisdictions other than, for example, Kazakhstan and Uzbekistan and out of Russia particularly, that they need to pay higher prices. And I think they're ready to start doing that. I think that, it'll be like a bit of a domino effect when you see somebody come out and say, okay, we're willing to pay those higher prices. And it's hard for them to kind of wrap their head around paying higher than market prices. But, that is really what it's going to take to inspire new supply. And I heard it from one of my peers, a very reputable CEO of a U.S. uranium development company last week at one of the conferences, said $75 is the incentive price. And he might be right. But, and so that's the kind of level that we think it can go to or it needs to go to in order to get new production going.
And for those of us who don't really follow the space that closely and don't know what's happening with utility companies, what can you tell us? Are you seeing more contracts, or is it still been pretty flat? Are you hearing talks of more contracts coming up soon? What do you think?
Yeah, I'm definitely hearing more contracts coming up soon. The phones are ringing, particularly Western utilities looking for sources of supply in Western countries. The phones are ringing. They're not the fastest moving organizations, but they recognize that they need to get contracts in place. And I think Cameco said it on their recent conference call. They're getting more interest. And I just know anecdotally from other companies, we're not taking calls ourselves. We have this partnership with Energy Fuels, but I know that they're getting quite a lot more calls.
Okay. So you guys have some kind of insight from EFR then. Mm-hmm. So, Consolidated stands in the shadow of a gold explorer, and then you guys became a pounds in the ground uranium bank essentially, and now you're a near-term mine developer. So are you able to touch on a bit more of the history of the company and talk us through the timeline in which the strategy has changed? And in answering this question, maybe tell us at what point in the company's life you decided to get involved.
Yeah, so it was 2 years ago in March that I got involved. It was, as you pointed out, it was a gold exploration company with assets in Western Australia and Nunavut. And it was fledgling at the time, and the markets were very difficult. But it had a great foundation of investors, and quite frankly, the board of directors was a standout board for a company of that size in that moment, and guys with significant experience in the uranium space. And so I sat down with them and we said, let's repurpose the company and go after uranium opportunities, believing that that better days were to come. We didn't know how long, and we thought that there was an opportunity to go and collect up assets at cycle low prices. And so we went about doing that. And then when the strategy has changed from just the bank kind of model that you're referring to the development model, as the uranium price started to move, and we see that the market will actually value advancing assets, and particularly having been through that last cycle where prices made that peak, they weren't there for that long, but so in being nimble and being able to deliver pounds in that moment is extremely important. And so having assets that are very close to production, we recognize the inherent value there, and that in order to be ready to produce, you have to go and do work on them. You can't just sit on them. So that's why we pivoted into working our projects more. And then the strategy is really to have these front end projects in production, and we want to have 2 or 3 proper development assets behind that. And whether those projects bubble up from our existing portfolio because we do work in Argentina and we realize, yeah, that's the project to move ahead, or whether we make some progress in Matoush and that's the project to move ahead, or whether we bring it from outside, we see ourselves as a multi-jurisdiction, multi-asset producer / developer ultimately.
Okay, so yeah, and your timing was obviously well done there. So do you guys still hold some of these gold assets? And, what's the plan for them now that you're entirely focused on uranium?
So we converted the interest that we had in the Nunavut projects into shares of a private company, Meliadine Gold, that owns the project. And so we're a passive shareholder there, and that project is still in the same situation that it was when we kind of left it. And then we still have our projects in Western Australia, and we're not spending a huge amount of time or energy there. They are very interesting on a number of different levels, and we don't get ourselves distracted, but I would expect that investors will see something on those projects over the next by the end of the year in terms of what the ultimate plan would be there. But we do see value there, and we're just trying to figure out the right way to realize that for shareholders.
Okay. And while we're talking company strategy here, are most eyes all on advancing your U.S. projects with the near-term cash flow, or do you think we can expect some further M&A?
Oh, I think you can definitely expect some further M&A. I mean, it's in our DNA, and we are firmly of the belief that we can add assets and projects that are complementary and make the whole company better. And it may be a sort of two-step thing: bring it in and then ultimately move it out into a separate entity, like we did with Labrador, or it might be a small tuck-in, or it might be a transformational acquisition. But we certainly think that more M&A is coming in the space. We've seen a number of deals happen, whether it's Deep Yellow and Vimy, or whether it was UEC acquiring the projects from Uranium One, or whether it was Encore acquiring Dewey Burdock. It's coming, and more is happening, and we think we're going to be in the center of it.
Okay, awesome. So, it sounds like you're not necessary. If you guys are going to engage in more acquisitions, it's not necessarily going to be, in the Southwest U.S. It could be anywhere as long as the asset's good and you think you can add value.
Correct. I mean, there's certain jurisdictions that we will stay away from, and when we look again, when we talk about building that diversified portfolio, because we're in such good jurisdictions. And you see, I look at it like we have Australia, Canada, and the U.S., very strong jurisdictions, good on all of those check marks. But so we were able to add Argentina because Argentina is a more risky jurisdiction. We like it a lot because it's a nuclear country. They're building more reactors and they need domestic supply, and they've been talking about that for a long time. But so in terms of, we'll probably follow the same model where it be one or two things in the more stable complementary jurisdictions, and then potentially something in a slightly more risky jurisdiction, because we see some other potential, whether it's on the project or whether the country is moving in a direction that we think makes sense for us to get into.
Okay, and yeah, we'll touch more on the jurisdiction in a bit, but while we're still on the topic of strategy, the consolidation business was successful in the last bull cycle, and you did touch on your rigid acquisition criteria. So, what is your main M&A criteria when you're looking at uranium projects?
I mean, look, we start with, the resources. We look at historical expenditures. We look at where they were positioned in the past cycle. We look at development characteristics. We look at how they fit with the portfolio.
Okay, fair enough.
And price, and how can we acquire them on an accretive basis? And I think if you look at our previous acquisitions, I think we're probably one of the more creative groups in terms of structuring deals. And I think we've been successful in structuring deals that were, even though ultimately we'll have paid very low prices for the assets, they were win-wins for the counterparties in that moment. And we provided the counterparties with some upside to future prices or the stock itself. And that's really our philosophy. We're looking to do a transaction that works for both parties.
Okay, and that feeds well into this question. So, are higher uranium prices making acquisitions more challenging? And when you're looking at other projects, do you guys have your own uranium price in mind? Like, are you are you acting as if, okay, let's just say prices are at $30 and treat this asset as if uranium prices are at $30? Is it still a good asset? Do you have some kind of internal price that you guys work with?
No, not specifically. I mean, we look at things on a relative basis and an absolute basis. To answer the first part of the question, certainly things are getting a little bit harder to acquire. But I think but there is a relativeness to that, right? So it's like, if you're selling a house that's gone up in value, you also still have to buy a house that's probably also gone up in value. So there is some relativity to it. I think what we're finding, though, specifically in the space is there are companies that have been around for 10, 15 years. It's the same management teams kicking the same rocks, and they're getting a bit fatigued. So where we're a new company with kind of new energy and enthusiasm for the space and for moving ahead and well capitalized, I think we're finding that there are still very much willing counterparties that want to transact with us. And then so on the price deck, we look at everything through multiple lenses. So we look at downside cases, we look at what the current market case is, and then we look at what it could be case. And then we kind of weight those, and then we get into the negotiation and we see, and it's kind of, okay, well, what's the pricing and the structure that the counterparty is looking at? And we've walked away from lots of things because we just couldn't get there.
Right. Okay, good answer. And circling back to jurisdiction now, obviously you guys like working in the Southwest US. You're open to Argentina. You're even open to Quebec. Are there certain places where you would avoid completely? And as well, specifically, someone wants to know about the Athabasca Basin and, why you guys aren't advancing anything there.
Yeah. Okay. So, let me start with the Athabasca. I mean, we would love to be in the Athabasca. I think everyone has acknowledged it's the premier jurisdiction for uranium. So full stop, we would love to be there. We went other places first because they were, we were a very small company when we started, and so we had limited resources to go after things, and those Athabasca assets were more expensive than what we could play. I think we're at that point, but we also have to figure out where it fits within the portfolio. And we're not explorers, and that's why we hived off and spun out Labrador Uranium. That is an exploration company. Of course, it has resources in the ground that they can expand upon, but ultimately they have an enormous package of ground and a very prolific belt that they're going to go explore. That's not our strategy. So Athabasca there's kind of two sides to the Athabasca. There's resources and development companies, and then there's the explorers. We're not going to get into exploration, is my feeling in this moment. So it's about which project and what would be a fit for us. There's certainly ideas out there. We just have to find, we need a hook. We need to figure out the right way for us to get into that jurisdiction and where we have an edge. And so far we just haven't found that. We're not anti it at all. We'd love to be there. And if there was an opportunity that came up, we'd certainly jump all over it. That made sense.
Yeah, for sure. And, as you mentioned, the Athabasca Basin, buying an asset there would be more expensive on a per pound basis.
Yeah. So we'd have to see that it really could add value to what we're doing. And right now we're feeling like, I showed you the metrics, we're trading at the low end of the range, and there's lots of reasons, and we can talk about why that might be the case. But, I'd like to right size that before we went on and paid a higher price per pound for something in the basin, which is what would be required right now.
Right. And you touched on Labrador Uranium too. So, great idea. You spun it out, but I guess I'm wondering, why didn't Consolidated keep any interest here, rather than just spinning it out completely?
That's not really our business plan. I mean, we don't want to hold shares in other companies per se, and we really thought that the thing to do was to give our shareholders direct exposure. So everyone got a stub of those shares, including ourselves. We're all shareholders, and we wanted direct exposure to that company. We stand by that, and that will be the strategy if we do another spin out going forward. It's about creating that value and giving it directly to shareholders, and it gave people the choice of whether they wanted to remain in that exposed to that vehicle. If we held it, then they don't really have that choice. They could, and I think it will turn out to be the right strategy. Other people hold shares, but it's not really our business plan.
Okay, and there's a lot more questions here, and we are at 45 minutes, but I'll try and run through some. So you mentioned your strategic alliance with Energy Fuels, touched on the toll milling agreement and operating agreement. And for those who aren't familiar, quickly, who are Energy Fuels? How do they compare with some of the other majors? And importantly, do you necessarily need their help in order to advance these projects?
Okay, that's a great question. So Energy Fuels, they're one of, and you could see in that comp table, they're one of the kind of top 3 uranium development companies in the US. They are both a conventional uranium developer and an in situ project developer. They have projects in Wyoming and Texas for in situ, and in Utah, Colorado, and New Mexico for conventional. The White Mesa Mill is their flagship asset, and that's really the center of the business. They are obviously very focused on uranium and vanadium. That mill produces both metals. They're also spending quite a lot of time more recently on rare earths. And I won't pretend to be an expert in what they're doing there, but they have had some very interesting news recently where they've acquired some rare earth projects in Brazil. But what's important again is the mill is kind of the center of their kind of hub and spoke model, where they can process rare earth ore that has radioactive material that not everyone else can do. So they have an advantage, and they've been working quite hard on developing some proprietary processing technology as well with some partners. They're a very strong, capable company. They have the history with these projects in the US. They have the mill that we have to send our ore to anyway. We'll ultimately, our ultimate goal is to build our own team up, increase our asset base in the area such that we can kind of run on our own steam. But ultimately, we will never. We want to continue this partnership. It's a great partnership, and having access to the mill where no one else has access, I think again puts us in very good standing. And so we'll continue to lean on that partnership, and it's been a great working relationship thus far. So yeah, I think we'll continue on with them because it's been great.
Awesome. And let's go back to incentive prices now. Are you guys waiting on a specific price before you flick the switch on your assets, and any hints as to what those prices could be?
Yeah, it's a good question. I mean, it's not so price is a big part of the equation. One part of the equation, and the other parts of the equation would be we have to understand exactly the cost profile of our assets, and that's work that we're doing right now. So aside from drilling, we're out getting quotes on mining contractors. What are the current costs of mining on a contract basis? They're different than they were 10, 12 years ago when these mines were done before. So we're getting that information and we're putting that into our model. And so when we get, and then what are the capital costs to turn these mines back on? We know they're very small because they're already been built, and most of the capital will be in working capital, not in significant projects like capital projects on the mines themselves. But so we're getting that information. So until we have all that information, we can't sort of pick the number. But what we need to get into position is it's not just that the price in that moment is at a certain level, and whether it's 65, 70, 75, whatever that number is, we have to see that it can stay there, or that we can realize that price over time in the mines. We can't turn the mines on and then suddenly shut them down because prices have just done what they just did. If I said to the audience that, hey, once it's $63.50, we're turning it on, we would have turned it on, and then we would have had to turn it off. So we need to. So, and that's part of the contracting picture. So how do you kind of find homes for your material that at the price that will kind of keep those mines on once you turn them on? So it's a dynamic kind of question that we'll get better answers to as we progress through the year here. The other part to the equation is the mill has to be on and running for us to send ore to it to get it processed, and the mill is not running uranium right now, and so we have to kind of align ourselves with Energy Fuels' plans to turn the mill back on, and not to speak for them, but recently I was marketing with Mark Chalmers in London, and he talked about kind of 6 to 12 month timetable once they made that decision, and they haven't made that decision just yet either.
Right. So yeah, I feel like a lot of people want to see an incentive price, but the reality is it's just not as simple as just spitting out a number. You know, as you said, you got to look at price stability and not just the absolute value, and you got to look at your margins as well. That's what's more important at the end of the day, right?
Correct. And what we're trying, so we position ourselves as a leverage play to the price of uranium. And so what we also want to make sure is that we're getting exposure to when the price does do those, if it does spike again into those more heady levels that we saw in the last bull market. So we can't just, what we don't want to do is just fix all of our material out at price X, which is the price that we, need to make the bare minimum profit. And then, okay, so we're selling at that price, and then the price goes up to $125 again, and investors say, okay, well, multiply the number of pounds by 125, and we're saying, no, actually we pre-sold it all at much lower prices just so that we could get into production. We don't want to do that. So we have, that's another dynamic that we have to sort of figure into the equation. Where we're, I think, uniquely positioned again relative to our peers is that because it's such a low capital cost to get these mines back in production, and we have that money on our balance sheet today, we can go and take a bit more of a risk with the material and not contract it all out at a fixed price. We can keep ourselves exposed to what we think are potentially much higher spot prices in the future.
Great, and we'll have 3 more questions here. So, let's talk vanadium now. Are you dependent on this commodity in order for your mines to be profitable, do you think, or do you think of vanadium more as a cherry on top of the uranium?
So definitely the latter, and I would point out that vanadium is only in the rim mine. It's not at Daneros or Tony M. So it doesn't even apply there. But it's a kind of nice cherry on top, and particularly with what some of the information that we're hearing. I mean, we're already seeing vanadium prices move up with steel prices. They've come off like a lot of things have just recently, but the future of kind of the vanadium flow battery story could really kickstart vanadium, and it's it's one of these things that we're starting to get quite smart on. And again, as we look around the world, we're seeing multiple projects with vanadium. So Labrador has vanadium. Our Argentina projects have vanadium. There's lots of vanadium down in the U.S. and then other projects around the world that we're looking at as well. So, we think it's a cherry on top, but a very interesting cherry.
Yeah, for sure. And do you have any plans to list in the U.S.?
So we do have an OTC listing right now. We are having some conversations. We're meeting with some groups at PDAC in a couple of weeks who are U.S. groups that would potentially want to pitch us on a bigger board listing. Certainly think that the U.S. those names that are trading at premiums in the U.S. are listed properly in the U.S. versus and the OTC is a proper listing, but a bigger board listing to correct the way I phrased that. That might be a reason why they're trading at those premium valuations, and so we're going to consider it strongly.
Right, and this is a good last question here, Phil, and feeding into this. So you touched on those trading multiples. It's amongst the lowest in your peer group, and I think you made a pretty strong case as to why you should be trading with your more in line with the more advanced developers here. Given that you guys are going to have a production decision this year. So I guess I'm wondering, what, in your view, what is the number one catalyst that's going to re-rate you guys? Is it going to be having that positive production decision, or do you think it's going to ultimately be the receipt of free cash flow or something else?
It's a good question. I'm not sure that might be the one that you stumped me on. I'm routinely surprised by the things that move the stock or don't move the stock, and the market or don't move the market. I think that this might be a case of it's not one catalyst, but it's continually getting out and telling the story of our U.S. projects and what's happening there. And the more that we, as we get better at articulating it, and I think that we're getting there, and we get the actual work programs happening, which is happening now, and we can communicate to the market that we are in a different category than you've got us in right now, then I think that maybe it will be one of those things where we're just keep telling the story, and then it catches on, and we didn't even know why it caught on, but it was because of that. one thing that we're doing, again, it's not really a catalyst, but we have a site visit coming up in 2 weeks where we have 7 analysts from different brokerages around Canada and in the US who are coming to see the projects. They're going to see the drill turn, they're going to see the mill, they're going to see all of the projects. And we're very grateful and thankful to have David covering us. But if we got some more coverage from the street, then I think that might also be very helpful.
Yeah, sure. Definitely great to have Dave on your, covering you guys. He is the, in my biased view, he is the go-to Bay Street uranium analyst. He's probably been doing it a lot longer than most other guys. So,
well, and I'm biased as well, because when I was a banker, I worked with David for 4.5 years, and he was the analyst covering all of the companies that I banked. So we have a very long and strong relationship, and a lot of respect for David, of course.
Yeah, of course. It's, getting the word out there, letting the market know that you guys should be trading higher and making a case for that. So, with that, Phil, I think you've done a great job at that. And, thank you for joining us today. And
thank you very much.
Thanks to everyone else for tuning in. And just a reminder here that Red Cloud Securities will be back Monday afternoon. Taylor Convoluzzi will be sitting down with Cavu, and that is May 30th at 2 p.m. Eastern. Thanks again, and have a great day.